Are you curious about reverse mortgages? Then you are in the right place. This presentation was created to walk you through a reverse mortgage, hopefully answering your questions and aiding you as you decide whether or not a reverse mortgage is the right step for you and your family. So what is a reverse mortgage, or HECM? HECM stands for Home Equity Conversion Mortgage. It is the only reverse mortgage that is insured by the United States federal government. It is also the only type of reverse mortgage offered by Pacific Community Credit Union. What types of HECMs are there, and what are the differences? There are two types, the HECM Standard and the HECM Saver. The HECM Saver is most applicable to those looking for a smaller loan amount and is especially appropriate if the homeowner expects to move or sell within a few short years. Because this type of loan is for a smaller amount, it also offers lower fees, a much lower upfront mortgage insurance premium, and offers loan amounts that are generally anywhere from 10 to 18% lower than the HECM Standard. The HECM Standard is the original program offered by the United States Department of Housing and Urban Development. The HECM Standards offers homeowners the largest loan amounts of any HECM program, but because of that, the HECM Standard also offers higher fees with mortgage insurance premiums at 2%. So how can a reverse mortgage help you and your family? If you are 62 plus and have equity in your home, a reverse mortgage can actually pay you to live there. So what's the catch? Though we will admit a reverse mortgage sounds too good to be true, it actually isn't. Reverse mortgages are designed so that the total charges never exceed the value of your home. So how does it work? A reverse mortgage is a loan that pays you by using the equity in your home. You may even be eligible if you still owe on your first mortgage. Are there any restrictions? In order to apply for a reverse mortgage, you must be at least 62 years old. You must also have some equity left in your home. The good thing about reverse mortgages is, unlike most loan programs, the government program offers no credit or income requirements. How are loan amounts calculated? In other words, how do you know how much money you will be getting? Reverse mortgage loans are calculated by the age of the borrowers, the value of the home, the current interest rates, the reverse mortgage program selected, and the maximum lending limit allowed on your home by the FHA. The maximum loan amount is currently $625,500. You may hear rumors about these programs, some good and some bad. The real question is, which of the rumors are true? Fact: a house becomes a source of income with a reverse mortgage. Basically, it breaks down to this. If you have equity in your home, you can get a loan amount for about half of the value of your home. The loan amount can be paid to you as one lump sum or as a regular monthly income in amounts of your choosing. So your home really would pay you to live there. Fact: you don't have to be low income to apply. Because this program has no income requirements, it doesn't matter how much you make. Fact: your children won't inherit your debt. Because reverse mortgages are non-recourse, meaning that the home's selling value is the only resource that can be used to pay the loan, your children are not responsible for any debt acquired because of a reverse mortgage. Fact: you won't be kicked out of your home. The primary fear of seniors is that it might lead them to lose their homes. With a reverse mortgage, you don't have to pay for anything while you're still alive and inside the house. It has also been designed so that your debt never exceeds the appraised value of your house. Myth: if you take out a reverse mortgage, the lender will own your home. False: you will still retain title and ownership of your homes during the life of the loan and have the option to sell it. You must, however, maintain the property and keep the taxes and insurance current. Myth: your children will be responsible for the repayment of the loan. False: reverse mortgages are non-recourse loans. Depending on the terms of the loan, when the homeowner dies or leaves the home, there should be no mortgage debt for the heirs to pay. Myth: there are restrictions on how reverse mortgage proceeds may be used. False: there are no restrictions. Many seniors use the money to purchase vacations, pay off debt, put aside cash for pending medical procedures not covered by Medicare, help with their kids, or establish a cash reserve. Myth: if you have a limited income, you will not qualify. Since a reverse mortgage pays you, many seniors who do not qualify for traditional financing are eligible for a reverse mortgage. Myth: reverse mortgage lenders take advantage of seniors. False. Seniors who have been victims of reverse mortgage lending schemes are the exception and typically a victim of an unsavory lender. However, it's a good idea to investigate your lender with the Better Business Bureau and National Reverse Mortgage Lenders Association. Myth: if you outlive your life expectancy, the lender will evict you. False. Reverse mortgage lenders put no time limit on how long seniors can stay in their homes, provided they follow the program guidelines. So how much does a reverse mortgage cost? When applying for a reverse mortgage, you must pay for a mandatory counseling session with a HECM counselor to ensure that you are making an educated decision. There are also some fees from both HUD and the FHA and associated closing costs and fees. Are there alternatives to a reverse mortgage? One alternative to a reverse mortgage is refinancing. Although it will not by any means pay you to live in your current home, refinancing is a great way to get a more affordable loan rate and payment on your current mortgage. Another alternative is downsizing. Basically, this means getting a smaller home. If you currently can't afford your home mortgage, consider purchasing a smaller home. If you have an extra bedroom in your home, you could consider renting a room for additional income. This is a great alternative for those who have a trusted relative or friend willing to move in and pay rent. If you are having trouble affording your mortgage, or if you are concerned about your debt, you could consider selling your home and renting. Although it leaves you with no equity, selling and then renting is a great way to save money. A home equity line of credit also uses the equity in your home. But for a home equity line of credit, you must have adequate income to apply, and there are monthly interest payments that must be made on the principal or interest. This is unlike a reverse mortgage that instead pays you and offers no monthly principal or interest payments. Is a reverse mortgage the right decision for you? You may not need a reverse mortgage if you have income, assets, and enough money to easily meet your daily needs and will have enough money to cover your retirement. Those who do get reverse mortgages use them for a variety of purposes, such as healthcare expenses. A recent Fidelity study estimates that a 65-year-old couple will need an average of $230,000 to pay for healthcare throughout their retirement, making a reverse mortgage a good option for many aging couples. Supplementing retirement income. Depending on how much you saved for retirement, you may need more than you once thought. A reverse mortgage is a great option, giving you more income to help get you through your golden years. Financing home repairs. Perhaps your home needs some repair or maybe just some decorating touches. A reverse mortgage is a great way to help you pay for them. Taking vacations. Your golden years are supposed to be the best time of your life. Thus, many seniors use their reverse mortgage to travel and explore the world. Purchasing new homes. What are the pros and cons of a reverse mortgage? Pros. There are no income or credit requirements. Closing costs can be funded through your reverse mortgage. You can stay in your home as long as you live. There are absolutely no restrictions on how you use the money. Depending on your plan, you can receive money without having to spend any. Counseling is required to ensure that you make an informed decision. Another pro is that you can actually use a reverse mortgage to purchase your next home if you choose. Cons. Closing costs can be high. Depending on where you live, a reverse mortgage loan could prove to be a barrier to qualifying for Medicaid, which counts the loan proceeds as an asset. Any indebtedness from an existing lien must typically be satisfied at closing or be subordinated to be eligible. Applicants must pay for the mandatory counseling between $100 and $250. Interest rates are typically 2 to 3% higher than alternatives such as a home equity line of credit. Why is Pacific Community Credit Union better for your reverse mortgage needs? Pacific Community Credit Union is proud to offer reverse mortgages direct and at a lower rate than most financial institutions. Call us to get started today at 800-656-2328 or visit our website at www.yourcreditunion.com for more information.